Welcome to the tax journey, which is part of our monthly, I say monthly, but I think our last one was about a month and a half ago, but our monthly webinar series. So we're trying to become more tax focused because we've been getting a lot of questions around the subject. But it's not always going to be a tax webinar. Sometimes Brian talks about Social Security, but you're in store for a good webinar today. Brian, welcome. You're going to teach us how to save on taxes?
Well, we're certainly going to talk about taxes, and we're going to talk about things that everybody should be thinking about. Not everybody. These are going to be ideas that about how the taxes work with your investments, and most importantly, the taxes at different phases of your life, because they ain't going away. And they will be applicable in different ways during different parts of your life. So we're going to talk about a lot of different ideas for sure. Yeah. So, Mike and I are partners with HBK Provident Advisors, of course, where there are three partners, Mike, myself, David Harper. Mike and David are in Florida. I'm in Western Pennsylvania. And, we very much pride ourselves on educating investors. Education is power in this regard. And as I had alluded to earlier, not everything that you hear today is going to be immediately applicable to you. Some of those things will be. Other things are items you'll just want to kind of have in your back pocket and think about over time. And so we borrowed some material from one of the partner firms, Delaware Life. Delaware Life was started in 2013. They have about $60 billion in assets, and they have a retirement education department. We happen to like this presentation. We don't have any formal partnership with them as independent advisors. There are a lot of insurance companies and investment managers that we can access and kind of pull off the shelf as they are applicable. We happen to like this material in particular. So let's jump right into this. The most important thing is the disclosures. So take a look at this. And the most important thing on the disclosure part is we don't give tax or legal advice. We give tax guidance, tax education, certainly don't give legal advice. There is kind of a triumvirate of folks in your financial life that would include your financial planner, your tax preparer, and your legal counsel for estate planning and things along those lines. Those folks should be working together. We are on the financial planning side of that triumvirate, and we do not prepare taxes for folks, but there's a lot of things that we work with our clients on that are have tax impacts. And so we think it's very important to be informed on these things. And that certainly is the spirit of what we're going to be talking about today.
But make sure everyone read that, because we're going to give you a quiz at the end.
Exactly. If you want credit for attending, there will be a quiz. Yeah, exactly. That's important information. So in the most general sense, the three phases of your life are when you're accumulating wealth, when during your retirement, when you are switching from your paycheck comes from your knowledge and your experience and the work that you do. In retirement, your paycheck comes from the money that you have saved and or Social Security. We'll talk a little bit about that as well.
Which stage do I get that convertible in?
Well, it could be any stage, depending on how things are going. So, okay. Of course, yes, it could be any stage, Mike. And then there's the wealth transfer. Ultimately, when you have accumulated some assets and you're enjoying your retirement, at some point you're going to say, wow, maybe this isn't all for me, or I don't need all of this right now, and I'm not going to be here at some point. And how do I pass that along in a relatively efficient way? And what we're going to find is what you should be, in our opinion, you should be considering about taxes in each of those phases will change. Not one phase is more important than the other. It's just slightly different. So we're going to talk about ideas along those lines. So we're start out with the accumulation phase and understand what you can control and what you can't control. Of course, there's three buckets in life. There's the things you can control, the things you can influence, and the things you can't do a darn thing about. Unfortunately, many of us spend time in the third bucket. There's nothing I can do about it. But if you read anything media related, whether it be social media or the traditional online print media type stuff, a lot of people focus on that third bucket. Can't do anything about it. So we're going to want to understand those. Probably the biggest questions we get are around retirement. All right, I got a bunch of money, and now how do I access it from these various types of accounts that I have in a fairly tax-friendly way? I would suggest to you that many people are surprised how much tax considerations there are in retirement. There has been a long-standing belief that you're going to pay a lot higher tax rates and that type of thing while you're working than when you retire. And then people get into retirement and say, well, I've done pretty good for myself. And now there are some things in that third bucket I can't do a thing about, and I'm getting taxed on them. So we'll talk a bit about tax efficient retirement planning. And then the distributions, how do you pass these things along? Some ideas in that regard. And then we'll talk about some next steps as well. So that's kind of our agenda for the day. Here are the tax brackets. Now, these are actually for 2026. We are mid-December 2025 as we speak. So I went ahead and started to look into 2026. Most of what's going to go on in your tax life for 2025 has concluded. There is a little bit of time, not much time, to get things done that may affect your 2025 taxes, but I decided to look forward in this regard. And so here's what the IRS has published. This is not a very pretty slide because it comes directly from the IRS's website, but these are marginal rates. And there's a little bit of confusion, as you'll see on the side, between marginal and effective rates, and I'll talk about that. But let's start right at the top. Your marginal rate as an individual is 37% if you make over 600, if your taxable income is 640,600, more than 640,600. And then in the parentheses, that is married filing jointly. So if you're married filing jointly in 2026, if your income is over 768,700, you're in the 30% marginal bracket. And again, marginal and effective are going to be very important. You go down to the 35. I'm actually going to focus on what's in the brackets. Many people that we work with are married filing jointly. So I'll kind of work on those numbers. But if you make over $512,450, then that amount over that up to that next level is at 35%. We're going to talk about how this is a progressive tax rate. And then you can see those going all the way down to the 12% tax bracket. So what that bottom line above the blue bar says is that if you make more than $24,800, then that money above that number up to $100,800 is at the 12% bracket. So those are the marginal rates. So exactly what does that mean? Well, it's a progressive tax structure that we have here in the United States. So what it says is up to, and I'm going to go right to that bottom line down there, up to $24,800, you're paying 10%. The next dollar after that, you're paying 12%, up to $100,800. If you make $100,801, that extra $1 above that is now at the 24%. So you can't look at this and say, hey, I'm going to make, I'll go right to the 32%. I made $403,551. Everything is taxed at 32%. It's not. Lower amounts are taxed at those lower brackets. That's where the effective rate comes in. Because you can't look at that, and in the 32% example, if you're married filing jointly, if you make $403,550, you can't say everything is taxed at 32%. It's a progressive rate. So you're not going to pay 32% on every dollar. The effective rate is going to be the rate that you actually pay. So you're not going to pay 32% on everything, and there's going to be deductions and things along those lines. And so you might not actually pay 32%. In a very basic example down there, if you're married filing jointly, you have $115,000 of income, your marginal rate is 22%, but you might only actually owe taxes of something like 12%, depending on what your specific situation is. So that's the big difference. In our financial planning, we're really looking at trying to, reduce the effective rate as much as possible, and certainly partnering with our clients' tax preparers in that regard as well. So that's kind of how the tax brackets work. And again, these
and
are
that slide
2026
compared to
numbers.
the 2025 numbers, it just basically the brackets all went up by 10,000.
Yeah, I think, let's see, in 2025, don't file your taxes in 2025. We'll look at the 22% bracket. I believe it was at 96,500, right around there.
Yep,
so effectively
96,950.
96,950. That was where the 22% started. So we got a little more room in the 12% bracket. So, if you're kind of in that range, you can make a little bit more money and still be in the 12 as opposed to jumping into the 22. So they kind of expanded those. The rates themselves, the 37, the 35, the 32, 24, 22, they stayed the same. So they index those. Well, the tax landscape changes constantly, but for what they did was they kind of indexed them for inflation. So you can make a little bit more money and stay in a lower tax bracket, possibly. All right, so let's talk about the accumulation phase. Right, you haven't retired yet. Your paycheck is still coming from your knowledge and your experience and the work that you do, but you want to save for the future. You want to save for those days that your knowledge is not as valuable to the workplace. You're plenty experienced, but you don't want to be working all day, every day like you have throughout your career. But so you're in your accumulation phase and you're thinking about the future. Well, again, here's the three buckets: the things that you can control, things that you can influence, somewhat control, and things you can't do a darn thing about. What you can control is what you save and how you save that. So you can control the percentage that you say. Now, a lot of people are going to say, no, I can't control that. The cost of eggs and milk and so on, things, those kind of things are much higher. Can't really control it, but you can, right? You pay yourself first. And then you figure out everything after that. You can also control where you put that money. We're going to talk about different places you can put that money and the investment selections you have within that. What do you have influence over? Well, you certainly have influence, but not direct control over your income. What is the job market like for your profession? And what is the company like that you're working for? Do you have your own company? And, what widget do you sell and how popular is it and that kind of thing? You could certainly influence that, but you can't really have direct control over it. Mm-hmm. And then you can't control the tax brackets, the tax rates. They are what they are. You can certainly understand the rules of taxes and use those rules as advantageously as possible for you. But when it comes to the actual tax rates, there's not much you can do about. So we really try to focus on the controllable things: is how much do you spend in your life, how much do you save in your life, and where do you put that money? Those are controllable. Unfortunately, Mike, as you know, we get a lot of calls about the other two categories: somewhat control and certainly no control. I can't believe it. Can't believe what Congress is doing. Well, I can't believe it either. We can spend all of our energy fighting it, or we can spend more of our energy understanding it and how it can be advantageous for us. So let's focus on the controllables. If you're going to maximize the things you can control, there are tax advantaged plans, oftentimes through the workplace. It's not 100% of the time, and not all employers are required to offer a savings plan where you can save. The most popular one is, of course, the 401k. Other types of businesses, nonprofits, could have a 403b. Government entities could have a 457. The federal government has what they call the TSP, the Thrift Savings Plan. There are many, many similarities of these plans, and so I'll kind of put them all into one bucket. You also have individual retirement accounts. So these are outside of the workplace. They are not sponsored by your company. You don't have to contribute to them directly out of your paycheck, like you might a 401k, 403b, 457, that type of plan. Mm-hmm. And there are different limitations, and we're going to talk about those limitations here in a second. But you can control, how much of your money, if it's out of your paycheck. Again, 401k could be a SEP, maybe simplified employee pension, could be 457 TSP. You can control how much you put into those, and there's really two ways to do it, and it comes down to taxes. It might not surprise anybody. There's a traditional, what they call is traditional, and then there's the Roth. And it really is when you pay the taxes. On a traditional structure, whether it be 401k, 403b, 457, or an IRA, you get a tax break on the way in. You get a deduction on the way in. The money grows tax protected. You don't pay taxes on it while it's there. And then you take the money out. Now, with the traditional structure, you get the tax break on the way in. You get a tax break while it's there. But then what comes next?
Retirement.
And then if you got a tax break on the way in and you got a tax break while it's there, what happens when you take it out?
Uncle Sam gets his cut.
All taxable. At some point in time, the IRS is going to say, hey, we've given you enough benefit on this thing. You got to start taking money out. And when you take money out, it's taxable. In general, everything in the tax rules are very black and white. Unless, right? Everything in the IRS is in the tax code it's either this or this. And then there's this unless part where there's all these other caveats. But in general, if you take money out of those types of plans prior to the age of 59 and a half, there is a 10% penalty and it's taxable. We strongly discourage people from doing this. After the age of 59.
And if you don't take your RMD amount, then that's also a tax penalty of, it's 25% now? Is that correct?
It is 25% now.
It used to be 50, I believe, right?
It was 50. And so, how that works is if you take money out before 59 and a half to 10% penalty, when you take money out, it's going to be taxable. You got a tax break. It was tax protected. Then the IRS says, hey, we want to tax this. Do it before 59 and a half. There's an extra penalty. And then there is a time period, which is called required minimum distribution that Mike was alluding to. And it depends on the required minimum distribution depends on your age, actually. Most people that are retired right now, it's the age of 73. So when you reach that required minimum distribution age, depending on your birth year, let's say it's 73 is when your RMD age is, you have to take a certain percentage of your money out of there. So not only do the IRS say, I'm giving you a deduction, I'm tax protecting it, but at some point in your life, they're going to say, hey, you got to start taking money. We want to get our hands on some of this money so we can tax it. And that's called required minimum distribution. And yes, Mike, you're right. If you don't do your required minimum distribution, you say, hey, I'm 73 years old. I don't need my IRA. I don't want to touch it. Tough luck, IRS. They're going to say no.
Maybe the government should just spend a little less and let us keep our taxes.
Well, that's certainly not in a bucket we can control. They'd like to make us believe that we can influence and through, elections and that kind of thing. Sometimes I feel like that is something that we can't really do about, but is what it is. So maybe they should. So we're going to talk about the limits on these things as well. Health savings accounts. I love the health savings account.
Oh, I'm a big fan. I have one personally. I try to max it out every year. It's really, the most tax-friendly vehicle I think I've ever seen. You get the deduction up front.
That's right.
It grows tax deferred. And if you use it for medical expenses, the distribution is tax-free. So it's a pretty sweet vehicle.
Kind of, we were talking about the 401ks and the IRAs, and the IRS says, hey, I want to tax this at some point. If you use the HSA, use their rules on how to use the HSA, that becomes tax-free money. It's incredible. There was a deduction, as Mike had alluded to, deferred. And then if you use it properly, use it tax-free. It's incredible. Huge fan of the health savings accounts.
Flexible spending account. This is a new one for me. I'm not too familiar with it. Could you explain basically what this is?
Yeah, so a flexible spending account is similar to an HSA in that there's a deduction and the money would grow tax friendly, and that if you use it properly, you don't pay taxes on the way out either. However, with the a flexible spending account, and what they're used for is kind of those gaps in health insurance. So it could be dental, vision, it could be co-pays and things along those lines. There's a very low contribution limit on these, which we will show you. That's one. But more importantly, with the FSA, Flexible Savings Account, it's a use it or lose it account. So you put money in there and you said, well, I had really no events where I needed to spend this. I got a tax break on the way in. It was growing tax deferred and I didn't really need to spend it. I'll just roll it over to the next year. No, you won't. This is a use it or lose it every year type of account. So if you put money into an FSA and get that tax break and it's growing tax deferred and you don't use it, it's gone.
So typically, is it employer or employee funded?
Yes,
Or does the
employee
employer?
funded.
Okay.
Yeah, it's most often employee funded. These are, bigger companies. Mike and I are owners of our company. Would be considered a small business. Not as many small businesses have these. These are often larger companies that offer this as part of a huge plan, huge benefits plan. So yeah, these are funded through employee deductions from your paycheck.
Okay.
So,
And then,
there's some nuances to the FSAs. There's a dependent FSA that you can use for childcare and or for adult care if you're, maybe you're taking care of your parents and that kind of thing. So there's a dependent FSA as well. And then there's a limited FSA, which is usually for dental and vision. So there are kind of nuances to it. They function the same way, but depending on how they're designated, it depends on what you can use the money for.
I also want to add, if you're a W-2 employee and your company doesn't offer employer-sponsored plan, there is options for you. You can feel free to give us a call. We can talk through those different options with you.
Yeah, exactly. Well, the IRA is one of them. 401k is through an employer. The IRA is outside of an employer. There are there are limits on the IRAs. On the traditional IRA, the limits it depends on whether you have access to a plan at work. There are income limits on how much you can deduct. So not everybody qualifies for a traditional IRA. Now, the Roth concept is different than the traditional. Let me detail that a little bit. The Roth concept is you don't get a tax break on the way in and gross tax deferred, and you potentially take it out tax-free later on if you have it for long enough and you follow the rules. And so with a Roth IRA, the limitations are really around your taxable, it's actually modified adjusted gross, but so it depends on your income if you can put money into a Roth at all, because again, there's no deduction, but there is a limitation. And there's a certain point that the IRS says, wait, you make too much money. You don't need a Roth IRA, so you don't get to contribute to it. If you have a Roth 401k, you still can, regardless of income. But a Roth IRA is limited. So the IRAs are one of those things that are outside of the company plan that you may qualify for. Traditional side, you might get a deduction. The Roth side, you might be able to contribute to it.
Yeah. And so there is options to do if you want to still go that Roth IRA route, where there's some loopholes in the tax code that you can technically still do one. It's just a multi-step process.
It is probably beyond the scope of our kind of surface level discussion, but there are ways for high income earners that are not eligible for a Roth IRA and are contributing a significant amount into their traditional 401ks. There could be a way. Contact us about that. The final one is deferred compensation. If you're working for a company that they are willing to defer what they owe you to some point in the future, that is something you might want to consider if you're having a big tax year and you're going to get a big bonus at the end of the year. If there is some way that your company would be willing to defer that into the future, kind of earmark it for you. I'm not going to give it to you now, but it is definitely yours at some point in the future. That might be something you want to toy with. So again, if you have, these are things that you can control, right? Am I putting anything into a Roth or traditional? How much am I putting away? How much am I saving for my future is what you can't control. And if you have this deferred compensation, you can say, hey, I want to, let's kick that can down the road, essentially. So here are your contribution limits. Speaking of, on a 401k, you can put 24,500. These are 2026 numbers, by the way. So you can put as much out of your own paycheck. This is not including company match. So in a lot of these 401ks and 403bs, 457s, that kind of thing, the entity, the government entity or your employer will say, hey, if you put X percent in, I'm going to kick in a little bit for you too. This 24,500 is just what you put in out of your paycheck. Now, if you're over the age of 50, you can put an extra $8,000 in starting in 2026. So that brings you to the 32,500 is what you can take out of your paycheck. hopefully your company's contributing and that, there's more going into that plan. Interestingly enough, between the ages of 60 and 63, the catch-up is $11,250. So don't read from on this left side under the 401k. Don't read that you can do all of these. Everybody can put 24,500. Anybody that's over the age of 50 can put 8,000. But if you're in that magical range of 60 to 63, you don't get 8,000 plus 11,250. You get 11,250 as your catch up, just 60 ages, 60, 61, 62, and 63. So if you're in that age bracket, you can actually do this catch up contribution is what they call it, 11,250, which would bring you to 35,750 in 2026. If you're in that 60 to 63, you don't get 8,000 additional and 11,250 additional. You get 11,250. IRA contribution limit for next year for those who qualify is $7,500, and there is a catch-up contribution for those over the age of 50 starting in 2026 of $1,100. Health savings account, $4,400 for an individual, $8,750 for a family, and then there's also a catch-up contribution there if you're age 55. So all these catch-up contributions were 50, this one 55. And then there's your flexible spending account limits, generally $3,400. The big increase from 25 to 26 was on the dependent care flexible savings account, which went from $5,000 to $7,500. I think that's in recognition that childcare is very expensive, and there are many people in the sandwich generation. The sandwich is your sandwich between taking care of your kids and taking care of your parents. Your sandwich right in the middle. I think they're recognizing that. And there was a pretty big increase. A 50% increase on that dependent care FSA. So there's your contribution limits for 2026. And, the question often becomes, well, then which one do I do? And that's kind of where the financial planning comes in. That's where some of the tax consideration comes in. It is what can you afford to do? One. And then where would those dollars be best served? Would it be in your company plan, in your IRA? Would it be in these FSAs? Would it be in your health savings account? And it can't answer that for you. If somebody comes to us and say, I've been saving a health savings account. I got a lot of money in there. Should I keep doing that? Maybe not. Maybe you start earmarking money for retirement and not just the healthcare retirement. If somebody comes to us and says, geez, I've been, max funding IRAs and 401ks for as long as I can, but man, healthcare is going to be a real killer. Maybe some of those dollars would be better served, some percentage of that going to the HSA. So it is a very personal decision. I hate to cop out on that. People say, I just wanted the answer. Well, there is no universal answer. My universal answer would be save as much as you can, as often as you can, and give yourself plenty of time towards your goals. That's the universal answer. But which of these accounts that each of those individual dollars should go to is going to be a function of financial planning and sitting down with those qualified professionals and saying, here's my scenario. Give me some ideas. All righty.
What else can we control?
What else can we control? Let me see here. We can control, what we exercise, but how much we eat, things along those lines. I'm not perfect with those things, but we certainly can. All right, so let's take a look at some of the hidden tax traps, which are, including short-term gains, ordinary dividends, and interest income, because they are taxed in a very similar way. So what are the hidden tax traps to identify as rebalancing? So rebalancing is in its most basic sense, and Mike, maybe I'll let you jump in on here. Mike's role in our firm is to do the investment management. So he's the portfolio manager for a lot of our clients. So if you would talk about what rebalancing is, everybody talks about it, but I don't think anybody really explains it. That's one. And then two, how that affects our discussion today.
Okay, so in a taxable account, a rebalance is basically, so let's take a look at a 60-40 portfolio, meaning you have 60% of your investments in equities and you have 40% in fixed income. Now we have a great year, we're up 20%. That 60 is going to grow relative to the bond portion. So now maybe you're 65% equities. Now, if you do a rebalance, that's going to sell the winners, meaning the equities in this case, and bring it back down to that 60% level. And in turn, in a taxable account, that's going to be a realized capital gain. So there's certain things you can do to try to limit that. Obviously, you want to, I mean, rebalances are pretty much necessary given your circumstances, because you don't want to end up taking on more risk than you really want to. It's great when the markets are going up, but then when the market declines 30% and you're participating more in that downside due to the more risky exposure in stocks. Mm-hmm. So you want to make sure you kind of stay within your overall risk tolerance. So you do a rebalance. Unfortunately, you have to pay taxes on it, but you can also take a look at your portfolio. Maybe you sell some things that haven't appreciated as much. Maybe you're focusing more on those long-term gains where the tax rate's more favorable as opposed to the short-term, which is characterized as under 12 months, a holding period. And then you can do certain things like putting your taxable fixed income the taxable fixed income in your retirement assets as opposed to having it in your taxable accounts, where you can do more of a focus maybe on munis or government bonds, for example.
Right. So that could be a one of those tax traps. You say, well, I want to get back to 60% stocks and 40% bonds. That's my long-term goal. That fits in with what I'm trying to accomplish. And, the market runs way up. And to Mike's point, maybe your stock portion is now 65% of your portfolio. And say, I want it to be 60. Well, if you sell things in a quick run up and you've held those investments for under 1 year, that is taxed very differently than for those investments that you hold for longer than 1 year. So that's kind of one of those things that we like to keep our eye on. We can certainly influence those. We can certainly control what we sell and when. But we've got to, maintain that balance between making sure that you are staying within what is an appropriate mix for you and not getting crushed on taxes while we're doing it.
And one other thing we do occasionally is, say you have a stock that's appreciated a lot. You've had it for years and years, but you've added the position over time. We take a look at the actual tax lots of that investment. Maybe we can sell some shares that haven't appreciated much, or maybe it's been recent weakness and you sell that for a loss. So make sure you're exploring those options as well.
Well, that's very well said. And that requires a good, more detailed accounting of how much you bought and when you bought it. Certainly are a lot of people that have accumulated a large amount in an individual company because over the years they bought it when it was low. They said, I really like this company. I got a few extra nickels. Then you buy some more, and then you buy some more. Not all of those pieces that you bought along the way are going to be taxed in the same way, potentially. So you might look at one of those pieces and say, let's sell that piece, but still keep, that stock in this example in my portfolio. Certainly something to do. All right. Taxable interest and ordinary dividends. They are taxed at your highest marginal rate. Short-term gains, highest marginal rate. Taxable interest and ordinary dividends also. That kind of goes back to what Mike was talking about. One consideration, this isn't for everybody, is to put the bond allocation. Let's go back to our 60-40. You got 60% stocks, 40% bonds. Maybe that 40% bond should be in an IRA. Why would that be? Because those bonds are kicking out interests, and that is taxed at your highest marginal rate. And a lot of people talk about the dividend-paying stocks. Oh, I love the dividend-paying stocks. I love that. Well, sure you do. But if you got a big dividend payers, maybe we put those in an IRA and keep them tax protected because they're kicking out dividends, which are a company's way of sharing their profits, essentially. And those dividends could be taxed at a less favorable rate than these long-term capital gains. So those are things that you want to keep in mind. So, taxable interest would be things like CDs, savings accounts, money market accounts, most bonds, not municipal bonds, they pay tax-free interest, but most bonds, those are the kind of things. Folks come to us and say, geez, my CDs aren't paying a lot. I need to get some better interest. Well, yeah, we can do that. But don't forget, that's adding to your taxes at a higher level. at your highest or at your marginal rate, which can be, pretty onerous. And then the short-term capital gains are taxed in a very similar way. Now, not all dividends are taxed the same way. There are qualified dividends that are taxed at capital gains rates. So it depends on what investments you own, and if they're paying dividends, some of them will pay qualified dividends, which are paid taxed at a lower rate, and then the ordinary dividends are not. So again, that's kind of one of those IRS rules. Dividends are black or white, unless, and so there are different types of dividends that equities will pay, stocks will pay. So let's talk about the retirement phase. This is where we get the most questions, because this is where the most surprises are, because so many people think, I got to pay a lot when I'm making money. But when I'm not making money, right, I'm off on the beach and doing my retirement thing. There's no taxes there because I'm not making a lot of money at work. That's wrong, especially if you saved a lot of money. So let's talk a little bit about taxes. So there is kind of this myth that people believe they'll pay lower capital gains rates during their accumulation phase than they will in their retirement phase. And not so much. On the far right-hand side, you can see in the blue box, there's something called net investment income, which is an additional 3.8% tax. And so for next year, it's for married filing jointly. If you have income over $250,000, the IRS says, hey, you're rich. And what do we like to do in this country? Love to tax the rich. And so on dividends and capital gains and some other things, you might owe an additional 3.8%. And that's where the 18.38% comes in, because you had a long-term capital gain potentially taxed at 15%. And then they add the 3.8% as well. So you got to kind of be careful about that. Especially in the first few years of retirement. Let's say you did some of that deferred comp idea, and maybe there's a big bonus in the final year, and there's a big thank you bonus for all of your efforts. Simultaneously, you're going to start taking money out of IRAs and selling investments so that you can buy your house on the beach and whatnot. It's quite possible that you can get into this net investment income tax, and it would be higher. It kind of sneaks up on people. Then you thought, well, I'm going to sell an investment that I've held for a year, and my capital gains rate is going to be 15%. It might be higher than that, 15%. So these are some of the things that kind of sneak up on you. This is one of my favorite slides here. We call this the tax triangle, although this is not a tax triangle. But if you think of each of these circles as points on a triangle, what they represent are investments that are always taxable, investments that are never taxable, and investments that are taxed at some point in time. That's the tax triangle. So a really well thought out plan is going to have a little bit of each. These taxable accounts are the most flexible. They don't have as many rules as to when you can take the money or if you have to take the money, but they're always taxable. If there are dividends or interest or things coming out of those accounts, you pay those in that year. If you sell those investments, either you pay the short-term or the long-term gain in that year. It's a fully taxable account, but it's a very flexible account. The tax-free accounts, that's what everybody wants. Tax-free accounts in the simplest version would be Roth accounts if you hold them for long enough and you are the correct age, and you can call us for the details on that. But as I had said earlier, you don't get a tax break on the way in. They grow tax deferred, and if you follow the rules, you take the money out tax-free. The other one that is mentioned in here is life insurance cash value. Now, why is life insurance cash value tax-free? Well, if you have a permanent life policy that does have cash value building up in there some way because you put extra premiums, you get dividends, or there are investment type vehicles where it has grown, you can actually access that cash without taxes. And it's because it's considered a loan. So loans are not taxable. They are not taxable income to you. So if you have, in this case, a life insurance policy with a bunch of cash in it, and you take it out and you use it for your retirement, that could potentially be tax-free because it is considered a loan from the insurance company to you.
And hence it's referred to many times as the rich man's Roth.
It is, it is. And, there are also other things that folks can do. You can actually, so if we go back to the green bucket, that's fully taxable. There is a way to take a loan against that as well. So you could actually take a loan against your, some people, not everybody, but that fully taxable account. There are ways that you can take a loan against that. This is where you hear about all these billionaires that don't pay taxes. Well, what they do is they have these enormous companies and they have an incredible, billions of dollars in shares of this company. And how are they not paying taxes? Well, oftentimes what could happen, and I'm not speaking to any individual, is they'll go to a bank and say, hey, I'll tell you what, I got a lot of these stocks over here. I built this company, I own this company, I got billions of dollars of stock, but I don't want to sell any of it because I'm going to have capital gains and all these tax problems on it. Would you give me a loan? And if I don't pay back my loan, then you go get to take my stocks. And that loan is not taxable. And that's why life insurance, a cash value of life insurance is also not taxable because you're technically taking a loan from money that you have in an insurance policy. And then you've got your tax deferred accounts. They're not taxed along the way, but they're going to be taxed at some point in time. Those are your traditional IRAs and 401ks, and those are annuities as well. You put money into an annuity, even if it's outside of an IRA, you're not paying taxes while it's sitting in there. You're paying taxes when it comes out. So that is tax deferred. So that's the tax triangles, things that are taxed all the time, things that are never going to be taxed, and things that are going to be taxed eventually. And
Brian, I'm going to put you on the spot here.
Oh boy.
You ready?
I don't know.
Okay. So as a certified financial planner, you have a couple come to you that's 45 years old, wants to sock away a bunch of money into investments. What portion would you put in the taxable account, tax-free account, and tax-deferred account if all those options are available to the person?
Whew. Wow. I'm going to cop out of that one and say there is no one answer to it. It's going to be depending on goals. It's going to be depending on, and I'll give some examples along those lines. It depends on what type of accounts they already have. If a 45-year-old couple comes and say, hey, we've never invested, we got all of our money in CDs. We're certainly going to look towards those tax deferred and tax-free type accounts. So we're going to diversify their asset location. Most people talk about diversification and asset allocation, right? I'm going to have stocks, bonds, international, domestic, large, mid, small. That's asset allocation. For somebody that's 45 and they've saved all their money in, CDs and mason jars in the backyard, we're going to look to diversify their asset location. If they're very high earners and they're socking away a ton of money in their 401ks and they've always kind of done the traditional route, we might want to look to diversify their asset location into more Roth because they're building themselves a huge tax bomb. At some point, you got to pay the piper and take the money out of those traditional accounts. And if they're pretty significant, that could be taxable. Conversely, if somebody comes to us and says, I save everything into my retirement plans, Roths, traditional, I max out everything, and I have $1,000 to my name in the bank, we're probably going to look to diversify their asset location and to start building up that taxable bucket. Hey, you want to have flexible dollars. Yeah, I know you're going to pay taxes along the way. It's always taxable account. We need a little bit more of that. So it really does depend, quite honestly.
Yeah, it's really important to build up the taxable account as well, because things will come up. You'll have to buy a new car. You'll have to get a new AC unit, medical expenses, and the IRA and Roth you can't access without penalty until 59 and a half. So
that's right. That's exactly right. And I've seen that happen before. People come to us with like breathtaking amounts for their age into a retirement plan and say, big retirement plan. And so, well, we're doing really well. Cash flow is all gone to the retirement plan. So we're really set up, and I would agree. And then they say, hey, we want to send somebody to college and we want to pay for it. Well, you might be able to use some. Again, this is the black or white. You can never take money out of a 401k, a traditional 401k. You might for a little bit of it. But those people might be in a pickle because everything is locked up into a type of account that has a lot of rules on it. And that might limit them significantly on being able to access that at certain ages. So that's why the tax triangle becomes very important.
Yeah.
So,
well, or we see people come to us and maybe they have $2-3 million in their retirement account and want to retire at age 50 and really don't have a taxable account built up. We'll say, well, I mean, unfortunately, the structure is going to make it very difficult for you to get income before you reached retirement age.
Yeah, that's exactly right. And that's probably a more common example. You see that a lot in the West Coast in particular. And I got the folks that have all these, huge stock positions in these technology companies, right? I put all of my company, I bought my company stock in my 401k, and man, it just grew. And look at me, I can retire right now. Well, yeah, I mean, how are you going to access this and live within the IRS rules and not get killed on penalties and taxes while you're taking it out and things along those lines? Yeah. All right. So that's the tax triangle. I love it.
Yeah. Don't wait too long to contact a financial professional, specifically Brian. He'll come up with a financial plan for you and make sure you're best situated for these different phases of taxation.
Yeah, and again, we'll look at asset location. Mike really focuses on asset allocation within our firm, how much we should have in different parts of the markets, if you will. And then from a planning perspective, we really try to look as much as we can at the asset location and what are your opportunities to diversify your location as well.
And here's our website and phone number if anyone wants to jot that down to reference later. We also have, obviously, the links on our Facebook page, LinkedIn page, YouTube, wherever you're viewing this live stream.
So here's an example of somebody that wants to stay in 2026. They want to stay in the 12% tax bracket as much as they can. Now, remember, it's marginal. If you go $1 outside of the tax bracket, that $1 is going to be taxed at 22%. Not, if you go over the $1, by $1, it's only that dollar that's getting taxed at the highest bracket. It's not like everything now retroactively is getting taxed at the higher bracket. So keep that in mind as well. But let's say somebody's got $60,000. Again, these are 2026 numbers, trying to stay in the tax bracket, the 12% tax bracket. So you've got tax deferred savings. So you take $60,000 out of your 401 or your IRA, let's say. And that's all taxable. It's a traditional. So you got a tax break on the way in, it grows tax deferred. Now you want to take it out. It's all taxable. So I'm going to take 60 grand. Okay, great. Let's say 40% of your Social Security benefits are taxable. We're going to talk about how we come to those numbers. But so, $40,000 of your overall Social Security benefits are considered taxable. But you get the standard deduction and married filing jointly in 2026 of $32,200. So you take $60,000 out of a tax deferred account. Now it's taxable. Your Social Security, $40,000 of the total Social Security coming into the household is considered taxable income. Yes, that can happen. Social Security does get taxed. And then you get this $32,000 deduction, brings you down to $67,800 of taxable income. But we know that you can go right to $100,800 in 2026 to stay in the 12% tax bracket. That leaves you $33,000 that you can take from somewhere that is taxable and stay within the 12% tax bracket. I am of the opinion and the approach that it's not a disaster if you go $100 over $100,800, because that $100 would be taxed at 22%. The rest would be taxed at either 10 or 12. So it's not a complete disaster. But if you're just absolutely dead set on staying in the 12%, and only the 12%, then you've got this extra $33,000 that you can take out of taxable accounts. What do you do with that? Well, there's a couple of things you could do with that. You could take it out and enjoy it. Possibly do a conversion. And so there is a way that you can move money out of a traditional structure, 401k or IRA, and put it into a Roth. Why would you do that? You take it out, you get taxed. Yes, you do. But if you take it out and put it into a Roth, you realize the tax is in this year. Now it's in a Roth. What happens in a Roth, Mike? It grows tax deferred. And what happens in the future if you keep it for long enough and live by the rules?
You take it out tax free.
It becomes tax free. So in this, a quick example of how do I stay within the 12% marginal tax rate, and I've got a little bit of room. In this example, the little bit of room is $33,000. That is a good time to consider, at least think about a Roth conversion. Why would you do a Roth conversion? Well, a couple different reasons. One, you're dwindling, you're chipping away more at your traditional IRA. And what happens when we turn 73, Mike?
You got to take money out and pay the government.
You are forced to take money out. So think about that. Now you have a traditional IRA. You've got in this example, you got a little room in your 12% tax bracket. And this year, take money out. Yes, it's taxed. Put it into a Roth. Possibly by the time you reach the age of 73, the traditional IRA is smaller, and therefore the forced amount that you have to take out, it's a percentage. The forced amount will be lower because the traditional is lower, and you start to build up this Roth that does not have that taxation. So that is the Roth conversion concept. Mike, I have heard this probably 10 times in the last week alone. Should I do a Roth? When should I do a Roth? Everybody loves the idea of getting the money into a tax-free account. Everybody begins to pause when you tell them, yeah, it's all taxable in the year you do the conversion.
Mm-hmm.
But
from a long-term benefit standpoint, would you say the best time to do that is sooner rather than later?
Yeah, again, many different factors. If you're still working, for example, in your early 60s, if you're still working, it becomes pretty challenging to convert from a traditional structure into a Roth because you're adding money to your taxable income and you still have income from work. Oftentimes, kind of like the IRS rules, it's absolutely black or white unless. If somebody is still working and they find themselves in a very low income year for some reason, bonuses are down, commissions are down. Maybe even though you're still working, you consider a Roth conversion. Kind of the sweet spot is after you leave the workplace, you don't have income from work. The income that you're going to have is from all of your savings. That's really kind of the sweet spot. And you're not quite at required minimum distribution age. So whatever that is, that's kind of the sweet spot to look and say, well, you don't have taxable income from your job, from your experience and your efforts. You have taxable income out of the traditional structure that you've been saving in. So maybe that's the time to realize some income from the traditional structure, because you don't have all this other income from work and that type of thing. So somewhere between not working a full-time job and the required minimum distribution age for your birth year is really when to consider these things. Another consideration would be, so let me throw this in there as well. So traditional IRAs, the traditional structure, when you pass them on to a non-spouse, you pass them on to a spouse, it goes into your spouse's name and it becomes their IRA effectively. If you pass it along to your children, there's new rules now. The new rule, if you pass it along to a spouse, they keep it as their IRA and then they can dwindle it slowly throughout their lifetime and keep it tax protected. If you pass it on to children or to somebody else, they have a 10-year clock for it to get taxed. So if something happens to me, I pass my IRA along to my children, they have 10 years to get that money out of there. At the end of the 10th year, the IRS says, I'm done protecting this money. Get it all out. So the IRAs have become less tax friendly to pass along. And so the Roth IRA conversion is a consideration for people who are willing to take the tax hit because they know that some portion of this are going to pass to their children. And maybe it's more efficient. If you look at the entire family, we have a little example in here on this. If you look at the family unit, maybe it's more efficient, less overall taxes for you to take the tax hit because possibly your children are in a really high tax bracket. And if you pass that along, the taxes on that money, if you look at your family as a unit, the taxes are going to be higher because you pass it along to somebody that now has to take it out over the next 10 years, and they're in a higher tax bracket than you. Again, that's why it's so very individualized. There's many people that we talk to and say, hey, you kind of want to pay these taxes for your kids, so you're not going to need all of this. You're going to pass it along to them, and then they got this 10-year clock. And they say, no, they can figure it out. Okay, fine. But that's another consideration. So that would be kind of the post-required minimum distribution people. Why the heck would you do it? A Roth conversion after. Very case dependent, though.
Yeah. And if you're early on your career, you get even more benefit doing a tax-free account like a Roth because your income's lower. The problem is you don't really have the money to put in. So maybe if you're a parent and you have a child starting out in a new career and you really want to help them out and you've made a nice nest egg for yourself, maybe you designate some money so they can fund their Roth so they can have a nice retirement.
Well, theoretically, if you're in a low tax bracket right now and you have some money to save, the Roth makes a ton of sense because that deduction's not very meaningful to you. Let's say you're in the 12%, for example, or even 10%, you got some money to throw into a Roth. Well, getting a deduction when you're only paying 10% in taxes is helpful, but it's not amazing. So in theory, you could look at it and say, when you're younger and your tax bracket is low and the deduction is not huge, go the Roth route. Just build up that part of your Roth triangle. As your income starts to get bigger and your tax bracket goes up, the deduction becomes more valuable to you at that time. And so maybe, throughout your life phase, you focus on Roth to build up that tax-free pot of money. And then as your tax bracket, because your income is going up, gets much higher, switch over to the traditional path and take the deductions. Now, over, say the first 20 years of your career, you could really knock out 2 of the 3 parts of the tax triangle. All right, this is how...
I was just going to add one thing. The traditional IRA income limit is so low. I always say if you're under the IRA limit to be eligible to do an IRA contribution, you don't need the deduction.
Yes, I would agree with that, and that kind of points us to the Roth. It's really very difficult to argue at any point in time in your life, or of the tax environment. It's really difficult to argue with having tax-free money. That's something to consider. All right, so this is how Social Security is taxed if you're married filing jointly, and your income is under $32,000, then Social Security is not taxed. If your income's between $32,000 and $44,000, it could be up to 50% of your Social Security benefits are considered taxable. It's not a 50% tax rate on your Social Security. It's 50% of what you're receiving in Social Security becomes taxable at your marginal rate. Over $44,000 for married filing jointly, up to 85% of those Social Security benefits you're receiving in the household could be considered taxable. And there's the single filer, 25,000 and below, 25 to 34 and over 34. Many people say that these numbers are very low. They are absolutely very low. They were established in 1983 and never indexed for inflation. That's why these numbers are so low. Long story long, your Social Security is probably going to get taxed, or at least some portion of it. All righty. All right. So here's Medicare premiums. Also, your Medicare could go up. These are 2026 numbers, by the way. These are the premiums. So if you are married filing jointly, it's kind of this middle bucket here, and you make and your income is $218,000 or less. Your Medicare monthly premium is $202.90. As your income goes up, your Medicare premiums could go higher. This is Medicare, CMS, Center for Medicare and Medicaid Services. This is their way of saying, hey, you got a ton of money. You shouldn't get discounted health care. So if you got a ton of money and you got a lot of money coming in, and then we could increase your Medicare premium. So when you're doing Roth conversions and realizing taxable income and stuff like that, this is one of the things that you want to consider. Now, this is on a 1-year basis. They look back 2 years. So in 2026, they're going to look at your 2024 taxes that you filed in April of 25. So it's kind of a 2-year look back. So in 2026, Medicare is going to look back at your 2024 income and say, hey, did you have too much money? We want to charge you more premiums. So if in 2024 you did a huge Roth conversion that brought you over higher, into these higher amounts, you could pay for 1 year higher Medicare premiums. These are reviewed, reanalyzed, and readjusted every year. This isn't something you get permanently stuck into. So keep that in mind. That's another one of those tax traps there. All right, let's talk about beneficiary planning. Think about your beneficiaries and what tax environment they live in from a state perspective. Some of your beneficiaries could live in a very high tax state. California, New York come to mind. I live in Pennsylvania. It's not far behind. Do they need the money? If on the IRA example, are they going to take it all out in the first year? Can they kind of take pieces of it out in those 10 years, those kind of things. And then think about, how that might affect grandchildren as well. This is really where the planning comes in. We sit down and say, hey, talk to me about what you got and where you want it to go, if there's anything left over. And then we kind of get into, how you might want to do that. If you look at this example here, so you got Abby. These are some beneficiaries, and
she gave you some money, Brian, huh?
Yeah, well, I was pretty excited about that. I actually didn't put my name in there, but I didn't change it either. So Abby gives money to Brian. Thank you, Abby. And now Brian has a whole bunch of money. Brian has two children, Chris and Dina. Chris is in the 12% tax bracket and Dina is in the 37% tax bracket. So a bunch of money goes from Abby to Brian. Brian's got a couple kids, and at some point the money's going to go to Chris and to Dina. Should it go equally? Well, it's tough to say. If Brian from Abby has a $300,000 IRA that he's going to pass along, and then Chris gets it and pays 12% of federal income tax when he takes it out because he's got 10 years. He's a non-spouse beneficiary. While Dina, she's going to get $150,000 and she's going to pay 37% on that. So when you look at the family unit between your tax bracket and your two children's tax brackets, where is the best way and the best time to take that money out so that the IRS is getting the least amount of that pot of money from your family, your overall family? And so there's a couple ways to do that. There's some considerations. Most people aren't going to say, I'm going to give all the money to Chris just because he's in a lower tax bracket. That's often not a great idea, but there are other planning techniques that you can pass along things to your beneficiaries, children in this case. You pass along things. By the way, my kids are not Chris and Dina, by the way. But there are ways that you can do that in a more tax sensible way that you are providing for your children. You are sharing what you have put together, but not crushing the entire family on taxes. In this example, I did give not me, Brian from Abby gave everything to Chris, and you could see the taxes, what the IRS got their hands on of that total 300 would be significantly less if you just gave it all to Chris. But Dina would be very put off. That's part of the financial planning process. Is we sit down and say, do you want to provide similar amounts for your children? Do you kind of want to make it equal? And what are the ways that we can do that? That kind of thing takes pre-planning, because if Abby gives the money to Brian and then Brian's gone and hasn't really thought about it and just left Chris and Dina on his beneficiaries, it is what it is at that point. So that takes a lot of thought and financial planning ahead of time. All right. So there's a beneficiary worksheet as well. All right, let's wrap this up. We're at about an hour. The general three stages. These are your accumulation phase, your retirement and distribution phase, and then your wealth transfer stage. And the accumulation phase in many ways is the easiest. Save as much as you can, as often as you can, give yourself plenty of money. It's when you get into this retirement phase, and then when you get into the wealth transfer, where it becomes much, 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 much more complicated and much, much, much more customized. different tax considerations for each part of your life. The accumulation phase, maybe you're in a lower tax bracket and you have all intention to get into a really high tax bracket by making a lot of money through your career. You want to think about that. You want to kind of keep your eye on the prize at the end. Do I have a good tax triangle? When I retire, am I going to get the choice as to how and when I pay the taxes? Maybe early in your retirement, you're taking out of all of a taxable account, and then you take some out of a tax-free account. Or maybe you do that Roth conversion idea, chip away at the taxable account, get those kind of taxes out of the way. And then later on, you have the fully taxable, fully flexible account and the tax-free account. That's when it kind of gets complicated, though. That's where the planning ahead comes in. And then we strongly suggest you sit down with a qualified financial professional who you give permission to speak with your qualified tax professional. And then if there's legal work that needs to be there, wills and trusts and powers of attorney, and kind of keep everybody on the same page. So, more important disclosures. I don't think we have a quiz on this final important disclosures.
No, you guys are safe.
So, I'm going to summarize real quick. And then, Mike, if there was any questions that came in, let me know. But I'm going to summarize really quickly in saying that this does require some thought and planning, one. Two, I'm not a huge fan in my financial planning approach. I'm not a huge fan of letting the tax tail wag the dog. I don't think you should make all of your life decisions just solely based on minimizing your taxes, but you definitely want to keep it in mind, right? I don't mind paying my fair share. I don't want to pay a penny more. And it does, require adjustments, planning, and, a good bit of thought and collaboration on how to make this best for you in the least costly way in regards to taxes.
Sounds good. It looks like everything was pretty much covered question-wise in the webinar. If we didn't give a detailed enough answer on anything, just reach out to us directly. We'll be happy to fill in some of those blanks.
And, we will do everything that we can to make it as simple as possible. And certainly, most importantly, make it as customizable as possible for you. All right, Mike. Well, thanks for having me on today. It's always a pleasure.
Yeah, this was great. Very informative. And we'll be having another one in anywhere from a month to a month and a half. I think you're still working on the topic, but something financial planning, whether it's taxes or Brian knows pretty much everything about Social Security. He's very passionate about that topic. So we'll definitely have another one of those at some point.
We're at the end of the year. Maybe we should look at market outlook.
Ooh, yeah, that's always a good one.
Kind of what are we thinking for the year? That also is customizable and very adjustable and changes every day. But we can have some thoughts on how we start out the year anyway.
Well, I'm signed up for the Jacksonville CFA chapter forecast get-together on January 15th. So I'll sharpen up my skills and try to take the crown for next year.
I've got faith, Mike. All righty, everybody be safe. Call us with any questions.
All right, take care.